Can you all hear me now? One second. Is this clear? No echo?
Yes, Sam, it's clear.
Okay, perfect. All right. Sorry for that. All right. So let me just quickly recap what we discussed. So I was saying that today's agenda is going to be about understanding the interest rate cycle because we've moved into a segment where you're seeing more rate cuts, and it's likely that you're going to be at a situation where your reinvestments are going to happen at a lower interest rate, right? So okay, great. All right. I think screen, audio, video, everything should be in order. I'm sorry. Right. So we're also going to look at what are some drivers behind rate cuts, what would encourage the RBI to cut interest rates, what may sort of keep them back from cutting interest rates in this environment. Then we're going to look at the risk return framework, right? So how do we look at fixed income as an asset class? What is the relationship between risk and return as far as fixed income is concerned? And finally, we're going to look at a few investment strategies for this market. So this is a great video, and I'll share the link in the description in some time. But essentially, it's something that comes from Ray Dalio's video on how the economic machine works. And the basic idea is that we need to understand how the interest rate cycle progresses, right? So you know that it is cyclical in nature, in the sense you have higher interest rates, then you have lower interest rates, and then you come back to higher interest rates over different points of time. But a key message that comes from Ray Dalio's understanding of the world is that you have a long-term cycle and a short-term cycle. The short-term cycle is primarily driven by credit, meaning how much there is in terms of borrowing and spending within the economy, and your long-term uh, cycle is sort of influenced by productivity and innovation. So when you look at your short term versus your long term cycle, most investors or market participants don't really know where we are in the cycle, right? Because what we are seeing is a very zoomed in view of time and the cost of borrowing. But when we zoom out and we kind of look at, okay, cyclically what's been happening, then I think there's a lot more clarity about where we stand at a particular point in time. Now, the most important thing is that credit can basically cause more variations in the cycle, because when we're able to borrow more, we spend more, but then we also take a longer time to repay that. So, in the borrowing phase, you see a sudden uptick in growth, inflation, and all of those things. In the repayment phase, you see this sort of sharply contracting, because essentially money is going towards repaying loans rather than anything else, right? Um, so now we come back to where we are. So if we look back at how interest rates have been over the last 10 years for India, back in 2015, our cost of borrowing was well above 7.5%, right? Then you had one rate cut cycle, which went on till about 2016, more or less. And you had your inflation targeting framework come in around that time. And then from there, you tried to rein in inflation into your 2 to 6% corridor and keep it close to 4%. Then you had a slowdown. So if you see, India's last rate cut cycle actually happened before COVID. Whereas for the rest of the world, COVID was the trigger that sort of induced your interest rate cuts. So we had a slowdown in 2019, and we had already started sort of cutting interest rates and supporting economic activity. And then when COVID hit, you had a steeper set of interest rate cuts. And then for a long time, that is almost 2 years, you were at a flat borrowing cost at the bottom. And then we've done these steeper interest rate hikes through 2022 and 2023. And for the last 2 years, that is from February 2023 till February 2025, we've been at a flat cost of borrowing at around 6.5%. So we've had the first rate cut occur in February this year, and our interest rate is now at 6.25%. Now, we need to think about, okay, this is our history. We've had steep interest rate cuts only when you've had a very big crisis like COVID occur. At the same time, you had a much gradual, like a more gradual interest rate cut when you had an economic slowdown, right? So if we look ahead, what are we really going to see? And I think here, I think there are a lot of interesting things that would show us the way forward or shed light on where we're heading. So the first is, of course, that we've had significant fiscal consolidation that's come in. So pre-COVID as well, I think the government was on track to sort of bring our deficit down, and there was a target deficit of around 3%. And I think even at that point, we were on track to achieve your target fiscal deficit. But of course, COVID happened and that threw a spanner in the works, and you could no longer sort of adhere to that particular target. But they revised the fiscal glide path, and if we see what the government has been doing post COVID, you're seeing that year on year they're able to either either meet or beat the target that they've set for themselves. At the same time, if you look at data points like GST collection or direct tax payment that's going on, you're seeing that year on year that's actually going up. So the shift to this new tax regime, the implementation of GST and the level at which it's taking off is clearly contributing to that fiscal glide path in a very positive manner. The second big change that we've seen in the last decade is, of course, that we have a flexible inflation targeting framework, which essentially tells the RBI that you do have a mandate to keep inflation at 4%, but you have some variation around that mandate, right? So it can be anywhere between 2 and 6%, but your target is around 4%. So prior to the inflation targeting mandate, the RBI wasn't really trying to create price stability, right? They would respond to certain crises or they would respond to certain things which would give us a better sense of managing inflation, but there was no clear number that they were working towards. So with a clear inflation number and steady movement towards a sustainable fiscal deficit, those are positive triggers that have really helped our macroeconomic situation. The third big thing which has happened maybe in the last 5 years is global bond index inclusion. So the trigger for this, of course, was very unexpected in because India hasn't really had a ratings upgrade as such. If we look at how the global rating agencies have portrayed India, we've not, although these positive changes have happened, they've not really put that into their thesis as to what our fair rating should be, and we are still investment grade, but we've not got an upgrade from them. But bond index inclusion essentially happened because you had Russia invading Ukraine, and then Russian bonds got removed from a lot of global bond indices, and then you had to look at some emerging market economy which would fill that gap. So with Russia as well as China going into this downturn, there was a risk of sentiment in both of these big heavyweights in emerging market indices, and then I think that opened the door of opportunity for India to enter into those indices. So by and large, I think a large portion of the buying that needs to happen on the index side has occurred. You still have a couple of smaller indices who will contribute to purchases through this year as well. So we've talked about tax collection, but let's also talk about our trade, right? So if we look at how India is trading, I think the two big initiatives that was Make in India as well as Make for the World, and the China plus one strategy that was coming, has helped us manage our trade deficit quite effectively. And you're only seeing more positive developments here. I think in today's context, of course, tariffs are a big sort of element that can change the game. But the reason I'm not going to spend too much time on tariffs is that, see, Trump is an unpredictable person, and he thinks unpredictability is great in terms of negotiating a better deal. And he is looking out for the best deal that he can get. But by and large, I think pretty much all economists as well as advisors would say that tariffs are not a strong response. And it's actually a lose-lose situation for everyone, and it's not something that the world can really afford at this point. Given that you have unpredictability versus a very practical opinion in terms of how this should play out, I think it doesn't make too much sense to talk about this because a lot of it is speculation, right? You have no control over how this is going to go. And the best way to respond to it is part by part. So, as and when these things unroll, and as and when you don't know, for instance, whether some of these tariffs will be rolled back or not, you need to be more proactive in your response in terms of as data comes about. Then, if we look at where India is in terms of growth, we are still among the fastest growing economies in the world. I think India is top because you still have advanced economies like the US growth forecasts are under 2% for this year from what the Fed is projecting. The ECB is even lower, and pretty much any other emerging economy is not growing at 6.5 to 7%. So, and that is sort of our sweet spot as to where we're going. I think a couple of years ago, something that got talked about a lot was India's demographic dividend and how, the India story is going to play out because we have a very young workforce, and basically, essentially, the way our population is structured is that we're not going to have the problems that aging economies have. And that includes the kind of macroeconomic problems that China, Japan, the US, and many other countries are going to face because they're going to have uh, an aging population, and at the same time they're not uh, getting any younger people into the workforce. So both by looking back as well as ahead, I think there are a lot of positives in terms of where we're heading. So if we see what we can expect going forward, all of these factors actually point to a better cost of borrowing for India, right? You have a ratings upgrade potential, you have flows that might support from the global economy, you have better macroeconomic conditions, you have better microeconomic conditions, and you have an underlying economy that's growing at a very fast pace and at a sustainable pace as well. So this all points towards a better outlook for Indian government bonds. So there's a very simple relationship between interest rates and bond prices. Ideally, when your interest rate goes up, your bond price is going to come down because people would want to own newly issued bonds which are paying a higher rate of interest. So the demand for older bonds reduces. Similarly, if your interest rate goes down, your bond price is going to go up because the demand for older bonds which are paying a higher interest rate will go up. So when we understand the nature of this inverse relationship and we see where we are positioned in this cycle, which is that we've already taken the first step towards a rate cut, and we are seeing inflation data coming at lower numbers month on month over the last 6 months. At the same time, we're also seeing economic slowdown occur. Maybe we're not a slow economy, but definitely we're slower than we were, say, 18 months ago. And at the same time, you also want to grow at a faster pace, right? So we want our target growth rate, or the projection that we've seen in the past has been closer to 7.5%, but today we're only at about 6.5%. So there are a lot of triggers that could actually push interest rates further down. So let's look at the RBI monetary policy. I think the first and foremost issue that they're trying to tackle is system liquidity. So if we look at where system liquidity has been in the last 1 year, it's been a very stressful year in terms of access to cash, right? You've had negative liquidity at certain points. You've had yield spike, that is your cost of borrowing go up simply because there wasn't enough liquidity in the system. So even immediately after the last rate cut, it was more the liquidity actions, that is in terms of open market operations and the FX swap that the RBI did that improved system liquidity rather than just the rate cut. So similarly, I think in December what they had done is they hadn't done a rate cut; they had just reduced your cash reserve ratio. So that also didn't really create surplus liquidity within the ecosystem. So now I think by and large, I think whatever actions they've taken have brought us to a more neutral uh, territory, and this will remain a concern because until you see positive liquidity in the system, you're not going to see better transmission that occurs in the monetary policy side. So it doesn't matter if the RBI cuts rates if the system liquidity is still tight. I think the next thing was that they wanted to enhance your deposit as well as credit growth. That has been something that's been top of the mind, and their instruction to banks as well as has been on these lines, right? Um, but I think structurally, given how people are saving today, maybe you're going to always have a CASA issue, or we're not going to go back to what we were in the past. Primarily because a lot of investors have realized that there are other avenues that give them that same level of security as well as liquidity. And this is with respect to how the mutual fund industry has grown and been able to capture some of this savings account, current account money that's been lying. The third and the most important thing is keeping inflation range bound, because when you keep inflation within a range, it helps maintain other macroeconomic parameters, and you have a more predictable sort of macroeconomic environment. At the same time, price stability also creates a lot of confidence within members of the economy, right? So for you and me to plan our expenses, to plan our savings, knowing that inflation is at a predictable rate or will be within a particular range helps us manage much better. The next thing is that the RBI, of course, wants to maintain household leverage. So if we look at how their interventions have been, they don't want households to be over leveraged. There has been a lot of attention that has gone towards microfinance institutions that have been lending, and the sub-lending culture that is there for these NBFCs and MFIs, where you're seeing households go into deep debt and not repay them. So Karnataka, I think, is an interesting case study for all of us who want to pursue this subject a little more in detail. But the basic idea is that if you have over-leveraged households, what would happen is that would sort of threaten financial stability. It can result in non-payment of loans. At the same time, it can push families into distress and result in all sorts of other issues that would come out of this. So, what is our expectation? If we think about the nature of this interest rate cycle, I think the rate cuts are going to be rather shallow, right? So, why are we looking at a shallow rate cut cycle? One, I think it's quite obvious that growth is positive, right? We are not in a 2019 situation where the economy is decelerating, or we're not in a COVID situation where you're talking about no or negative growth, right? So you are positive and you are above average or at the average level. At the same time, you see that inflation risks persist on both sides, right? Meaning, right now we've had a low reading below 4% for the last month, but at the same time, we don't know where the monsoon stands, what geopolitics could play, what kind of role geopolitics could play in pushing inflation up. And because risks exist on both sides of the mandate, it's going to be a lot more difficult for the RBI to sort of clearly move in only one direction. That's also why we think that the stance is neutral. We will have more clarity on this, of course, with each policy and each meeting announcement, because that gives us more insight into how the RBI is thinking. And more importantly, we've had a full shift in terms of the committee. So the governor has changed, underlying committee members have also changed. So it's harder to get a read on this committee because we really don't know much about how these people are thinking. We've only had one meeting where we've had these thoughts come out in the open. Maybe in a few more meetings, it'll be easier to gauge how the RBI is uh, perceiving certain issues. Um, if we look at how advanced economies are moving, so let's take the Fed, for example, the kind of projections they've shown in terms of interest rate cuts, is that sustainable amount, right? Because there are many moving parts in that equation. You do realize that inflation is going to be a little bit higher. Part of that is because of tariffs, part of that is because of other things. And tariffs are going to play a big role in deciding how much you can actually cut interest rates. Because if you get inflation from goods, which you've not really had in the past. You've had services and wage inflation, but you've not really seen goods inflation outside of that COVID window. You're going to have a harder time sort of using interest rates to control that. So if say the Fed is not cutting rates and or the ECB is not cutting rates, how much can India really diverge from there, right? Because if you have a lower interest rate, then that affects all sorts of other parameters and trade opportunities. So and the last thing, of course, is that rupee volatility is a concern. So if we see a lot of depreciation, we can't really afford to cut more rates. We would have to do something else to ensure that we have a more stable economic outlook. So now let's start rethinking the way that we're looking at risk now that we know that we're moving into an interest rate, into a lower interest rate environment. So one important thing is that for investors, we always focus on inflation risk when we are doing fixed income investments because you want to see that on a post-tax, post-inflation basis, you're still earning a positive return. At today's point, we're close to the peak of the interest rate cycle, meaning we're slightly away from the peak, but we're still at the top, right? We're not closer to the bottom. We've had only one rate cut happen so far. If we think about inflation risk, then it's quite clear that you don't really have to worry about inflation that much because your inflation is clearly coming down. Uh, and then from a post inflation post tax basis, you are on a better wicket. So investors who are able to lock in earlier in the rate cut cycle are definitely not going to have inflation as a source of concern. If you are looking at locking in later, then your return itself expectations will be lower and your inflation expectations would also be lower. Today, we are in the sweet spot where your return expectations are higher, your inflation expectations are lower, right? So this is a great time for you to capture that opportunity. The next thing that we have to think about is duration. So let me just explain what duration risk is. We saw the nature of how prices and interest rates affect each other, right? So if the interest rate is moving up, your prices are going to move down, and this movement is more pronounced depending on how much duration risk you take. So the more duration risk you take, the more pronounced that up and down movement is in terms of bond prices. The less duration risk that you take, the less pronounced that's going to be. When you're in an upward interest rate cycle, duration risk is something that you need to be very, very mindful of because you could make mark to market losses on the investments that you're making. If you're on a downward interest rate cycle, you really don't need to think so much about duration risk. It's actually not a bad thing to have higher duration in this market, primarily because you're going to get some mark to market gains as the cycle moves downwards and as your yields also move down. But what we really need to think about is reinvestment risk. So, for an investor who's participating in markets today, the interest that you earn, right, whether you own bonds, whether you own a fixed deposit, or whether you have a mutual fund in your portfolio, you need to think about when your income comes into that particular investment, how are you going to be able to reinvest it at the same rate? When interest rates are moving down, your reinvestment rate is also going to move down. So every investor has to think about product solutions that are going to solve for reinvestment risk, right? Meaning you want to be sure that you're locking in a good return, and you don't want to get stuck where you're reinvesting all of your money at the lowest point in the interest rate cycle. So uh, focusing on reinvestment risk and thinking about how that's going to get managed is going to make a huge difference in making sure that you are getting the right products into your portfolio. Now, given our context today, I think it makes a lot of sense to think about market volatility. We've had a really stellar run of 4 years in the market from COVID, let's say 2020, March, April, all the way until September last year. In the last 6 months between September and now, you've seen some level of market volatility, you've seen drawdowns, and investors are rethinking the landscape of their investments in terms of where they should be putting incremental money and whether it's worth participating in equity markets when they can be so volatile. One important shift that has happened is that we are actually in a more normal equity market now than we were in the last few years, primarily because market volatility is quite normal for an equity instrument. Investors have just experienced a phase where they've not seen market volatility because you had all drivers firing at the same time, right? Meaning you had positive growth, you had at the same time margin expansion, revenue growth, all of these, and lower interest rates kicking in all at the same time, um, giving you this boost, and then you've had the markets respond to that, and now you're seeing some correction in terms of you've seen already some revenue slowdown. You can also see margins flattening out or even compressing from here, and then you can have a re-rating, right? So when that re-rating cycle goes by, then you're clearly going to end up in a situation where what you pay for each company or each instrument is going to change, right? What you think the fair value is going to change. So when there is a lot more market volatility, investors start to think about being more risk off, and fixed income is a great solution to that because it allows you to take a step back, but also come back into the markets whenever you feel like the time is right. So when we think about market volatility, for somebody who wants more uh, predictability, for somebody who wants more certainty in what their return for the year is going to look like, then fixed income gives you that kind of visibility. At the same time, for somebody who just wants to pause, right, on equity markets and come back when they feel like, fixed income works for that investor too. So when we start looking from the lens of market volatility, it makes a lot more sense to look at how fixed income can fix that particular risk. We also need to think about liquidity. And I think this is where it gets a little tricky because there is always a trade off between liquidity and returns. So if you're thinking of high yield bonds, then there is a question mark over how much liquidity you will have, whether you'll be able to sell and buy as easily as you would like to. At the same time, if you want assured liquidity and you're looking on the mutual fund space, your return potential is going to reduce fairly significantly. So, what an investor really needs to focus on is their investment horizon, whether there be any urgent need for this money or not, and how to choose the right instrument based on these two parameters. So now let's rethink how risk works, and let's talk about credit risk, right? Because in this market, when this shift from equity to debt happens at the market level, and more investors are concerned by equity markets, they tend to flock to debt. And in debt, the risk reward is very clear. Unlike equity, where you can actually have low risk investments that give you high rewards and high risk investments that give you nothing, I think the risk reward relationship of fixed income is fairly linear, meaning the more risk you take, the higher the reward potential. But the less risk you take, the more certain you are. When we take more risk in fixed income, we need to be very cognizant that there is a is a return ceiling, right? So that incremental risk that you take should be very minimal. You don't need to go out on a limb and stretch and sort of reach for something because it's giving you a 15% or an 18% return, because is the risks that are associated with taking that return are really not worth it. And if we look at how people have thought about investing in markets, I think it's fairly clear that we've been caught by surprise so many times. And let's just look at the history over the last decade, right? So you had a big default in terms of INFS. And after INFS, it was assumed that, okay, all the skeletons are out of the closet. But then you had DHFL also default, right? Then you had PMC Bank, which was a cooperative bank default. And then you thought the cooperative bank story is over. But then even recently, you've had an issue in Maharashtra again with New India Co-op. So uh, things that we've seen once occur again and again. So whether it's with respect to a big NBFC defaulting, whether it's with respect to additional tier 1 or tier 2 bonds being written off in a bankruptcy or insolvency situation. You've had that with Yes Bank, and you had it again with LVB. And something that was unprecedented in the industry was winding down of 6 mutual fund schemes on the debt side. Now, actually, there was no default there, right? What happened was that you had a liquidity and asset liability mismatch within the portfolio, and investors have got their money, but it was in a longer term than they expected and in a different manner than they expected. So we really need to rethink of credit risk, because credit risk is not just that you don't get your money back. It is that you also get your money back over a longer period of time than you plan to invest over. So, what should your fixed income strategy be like today? I think one, that interest rates have peaked out. So, as an investor, you really need to think about how you can manage reinvestment risk better. We are at a flat yield curve, which basically means that there isn't too much additional reward coming in from taking on more duration risk. So we need to think outside the box, right? So if you're not comfortable taking duration risk, you can look at moving a little bit down the credit curve and seeing whether you're comfortable with where corporate bond yields are. You're also seeing structural shifts in the yield curve. And we've talked about how the Indian economy is coming out stronger. You have a lot of these big drivers that will push us towards a better cost of borrowing in the future. So here, the investor really needs to think about their investment horizon and pick products that work accordingly. The last is that in every cycle, we've seen that we always tend to chase performance, right? Wherever it's coming from. So even though last year was a great year to invest in fixed income, many investors chose to stay out because equity markets were giving you better returns. But the risk reward in equity was not very favorable. Now, after you've seen gold and silver move up quite a bit, investors are coming back to the table and saying, okay, why don't we look at precious metal allocation? But chasing performance rarely creates wealth, and it's more important in the fixed income space to prioritize safety. So it doesn't make a lot of sense to take these high yield calls if they're not giving you adequate safety and everything else that you're expecting out of that investment. So I'd quickly like to talk about what we do here at Finesse and Milestones to Wealth. Finesse is a fixed income learning space, and Milestones to Wealth is a program that we're running for small investors, helping them think big and achieving big goals. So our basic promise here is that we're going to help you get from wherever you are to your first crore in savings. And that means we're going to handhold you through this process because there are a lot of decisions that you'll need to make. We're going to guide you through the ups and downs in the market, and we have a lot of sessions like these where you can learn. So our big initiative is Learning Saturdays, and there are at least 2 or 3 webinars that we conduct under the Milestones to Wealth program on a weekly basis. So anything that you are interested in, you can always find a topic, and it's fresh. It's something new to discuss every single time. Uh, So coming back to that, I think this is a process where you need somebody to coach and mentor you through this entire journey. And you also need to really measure what you're doing. So when we're able to do this, I think you end up in a much better space because we help you develop a growth mindset. We help you build investment conviction at the right points. We inculcate a sense of financial discipline in your journey, which essentially helps you capture all the opportunities that you need to at the right time with the right advice. You also have a clear map to wealth, meaning you know how you're going to reach that 1 crore, you know which milestone you are at and which milestone you need to work towards. And there are clear timelines in which you can achieve it. There are timelines that we can set to help you stretch and achieve your goals at a shorter span of time. And you also realize that you are scalable, meaning you can do a lot more than you imagined with the right guidance. So the idea is from wherever you are to your first crore in savings, milestones to wealth will work with you and help you get there. So just a little bit about what we do on the finance side. We have a monthly outlook which gets published on our website. You can read it. It gives you a clear insight into how we're thinking about markets. We also conduct monthly webinars like the one we did today. We help investors with product selection. So anyone who's enrolled in the M2W program will get guidance on what kind of products suit them. We also do investment reviews. So if you have a portfolio and you want us to take a look at it and see whether you've done the right thing, that is something that we can do for investors in M2W. And we help you construct a portfolio that will help you get to that 1 crore that you're thinking of. So without that, without further ado, let me open up to Q&A and let's take any questions that are coming in. And these are our numbers. I'm just going to leave it on the screen so that anybody who wants to sort of get in touch or have a more detailed one-on-one conversation, you can write to us at info@milestones2wealth, or you can quickly drop us a message on 967700000613. So if you have any questions, feel free to type them into the chat box or into the Q&A section. Okay, so I see. Okay. With lower interest rates combined with full tax as per slab, debt funds or products be below inflation, not even needing it. So how is it useful to beat inflation as an asset class? Also, as a common retail investor, how can we really time it, make use of these situations, etc. as well? Right. So, see, I think tax is one thing that you really cannot control, and we need to think about preserving wealth. I think where we are today, you can still make a positive post-tax return. And if your inflation is closer to 4%, I think for most people, there would be some marginal differentiation, right? Meaning if your inflation is at 4% and your return is around 7% on a post-tax basis, you would make something like 4.95%. And then if you take out inflation from that, you will be left with about 1% as your post-tax, post-inflation return. So, and you're not taking too much risk to earn a 7% return today. I think if you look at the highest rated or highest quality investments, that's there. Now, obviously, if you move down the credit curve and you start looking at slightly more um, lower rated bonds or fixed deposits or any other instrument of your choice, then automatically there as well, you get a slightly higher return, and then your initial post-tax return itself is going to be higher than your inflation number. So the choice for the investor is to either choose a lower return with a higher level of safety or a higher return with a lower level of safety. Okay. Also, there are about 16 types or categories of debt fund products available. So how do we know which ones we need to focus or choose as our option? Is debt funds really meant for retail clients or common investors? So I think today's market structure for debt funds is actually much better and more investor friendly than it was, say, maybe even like 10 years ago, because SEBI came in between and said that they wanted to do a recategorization of debt funds, ideally to help investors figure out what is suitable. So the funds are actually quite neatly organized because you are segmented based on duration, and that is essentially along. So if your investment horizon is less than 3 months, you have a particular category of funds. If your horizon is less than 6 months, you have a particular category of funds, and so on. If you're having difficulty with product selection, then I do think that you should take professional advice from whoever you are comfortable taking professional advice with, because the categories are fairly investor friendly. Like, it tells you what the mandate for that category is, and it's a little bit easier to compare within a category as well. So I think the product demarcation is fairly good. Okay. For a long-term investor who wants to build a fixed income portfolio looking for an investment horizon of 5 years, what is the best debt fund option considering the current cycle? So, see, if you want to build a debt fund, it again depends on what kind of risk you want, right? There is no one solution to these kind of answers, and it is more of a personal discussion. So, you need to talk to your advisor and tell them. Some people are comfortable taking credit risk, which means you can take a credit oriented fund, or you can look at funds that are not government securities. There are some people who would prefer to take duration risk in this time, and that difference is available even within fund managers. So if you see one AMC to another AMC, the view is different for 5 years. It just depends on what you are comfortable doing and what you're not comfortable doing. So this is something that you need to have a deeper conversation with your advisor. Okay, so one more question. Are NCDs the same as bonds? Yes, NCDs stand for non-convertible debentures. The basic idea is that you had convertible as well as non-convertible debentures. Convertible debentures essentially mean that the bond that you own at some point could become an equity security. And NCD essentially says that if you own a bond, it will remain a bond through its life. We still have time for maybe one or two more questions. So if anybody has anything on their mind that they would like to discuss, or that they would like to um, get more insights on, we're happy to take that in the next 5 minutes. No, not really. In terms of bond buying platforms, no. We don't recommend any platforms. I think that's up to the investor. You can get it from any, uh, like if you're on any uh, trading platform, you should be able to access bonds, but we would not advertise or advocate for any, because bond selection is actually a very nuanced thing, meaning you need to know what are the covenants of the bonds, and most of the platforms do not tell you what are the underlying risks. So it is, I think, if you don't understand the market, you should not be doing it on, because it's not like equities, right? If you make a mistake in bond, like if you buy 5 bonds and you make one of them does not repay, then the other four are not going to compensate for that. So it's not advisable to participate in things that you don't understand. And I would pay a lot more attention to risks. Given equities have dropped recently in India and in US, how do we balance fixed income versus investing in equities during this fall? I think this is a great time for you to actually allocate to fixed income. I think that's been the essence of today's conversation, meaning this is a time where you're getting a once in a lifetime opportunity. You know that equity markets are going to be volatile. You know that precious metals have rallied quite a bit. And at the same time, we're also looking at uh, fixed income from the lens of both income as well as capital appreciation. So I don't think there could be a better time for you to really look at fixed income. Yes, if you want to buy, if you're an ITHOT client and you want to buy bonds, you can speak to your advisor and they will assist you with the process. We don't have a platform per se, but we do have uh, certain partnerships where we can work on this. So, Mr. Purushothaman, if you have 33 mutual funds and you want to bring it down and consolidate it, maybe 2 or 3 is a little too less, but you can share your portfolio. Why don't you just drop a message? You can send your NSDL or whatever statement you have to our WhatsApp number, and they will be able to assist you on what we can do next and how we can review and structure your portfolio. We mostly do so within N2W, we mostly do debt mutual funds because we are largely working with smaller investors, and the bonds are normally require a larger ticket size. So you might have to do anywhere between 1 to 10 lakhs as a minimum investment in a bond. Uh, so you can do both instruments, but ideally, I think the average N2W investor prefers the mutual fund. We can do deposits as well. So if that is something that was not explicitly stated. Okay, what's your view or opinion on locking into pension plans, etc., to avoid both duration and reinvestment risk? Because these products lock in fixed rate over a long time, and we can consider these though they are illiquid. So, see, in a pension product, the biggest risk is inflation because if you're going to lock in for 20 years or like your entire retirement timeline into a particular asset, you want to maintain a certain quality of living, right? So, having one portion of your corpus which is giving you a steady fixed return makes sense. But if you're thinking from an estate planning perspective, again, so these questions are very personal, and I would suggest that you talk or you set up some time with an advisor to discuss this in more detail. But you need to think about, okay, is there a legacy that you want to leave behind for your next generation? Uh, then in that case, maybe you don't want to lock into a pension plan, right? Because certain pension products do not give you return of capital, and those that do give you return of capital will lower the pension that you earn. So there's always that trade-off between the lifestyle that you have versus what you want to leave for the next generation. Uh, and inflation risk is a big thing, right? Like if we look at interest rates in the 90s, it was around 12%. Today, 25, 30 years later, you're seeing that uh, like your FD rates are at 6.5, 7%, right? So that is how much your purchasing power has sort of eroded over time. And you need to keep that in mind before you lock into anything, because the next 20 years also you could see a very different inflation scenario. And that fixed, like for somebody who thinks that 1 lakh is a decent income to have today, maybe 15 years down the line that may not be a decent income. So it needs to be done in consultation with your entire retirement corpus and see whether it makes sense. And whatever it is, you need to have some flexibility, right? Everything cannot go into one product. Same way, like if you want to lock into other equity or fixed income instruments, you need to make sure that you have some flexibility in your portfolio. Okay. Thank you, everyone. I think it's already become 11 and I don't see any new questions coming in. So I would just like to thank everyone who's come in today and asked questions and participated. These have been very interesting things to answer. And we look forward to seeing you at our next Finesse webinar next month. And in the meantime, if you're interested, keep track of what we're doing. You can follow us on social media and you'll get all the updates on what webinars we have in store for April, and it'll be great to see you participate in something else very soon. Thank you.